Thank you for joining us at the Milken conference today.
Well, great to be here, Cristina.
The one thing that I have a question for you on is you run a business at Blackstone that essentially invests in hedge funds on behalf of institutional investors.
That's correct.
You've grown the business to the biggest of its kind today. And I'm just curious, describe the appetite for me in terms of investor appetite for hedge funds right now, and more specifically, what strategies are most popular, most in demand at this point?
Well, if you go back to 1990, there was only $40 billion in hedge funds. Today, there is $2 trillion. Back in 1990, it was largely a high net worth marketplace with some endowments and foundations, but virtually no sovereign wealth funds, no large pension plans, no significant investors. Today, the vast majority of the $2 trillion come from institutions. And it used to be a largely US and Europe in terms of where the money was coming from. Now it's a global marketplace. And so as we think about strategies, what we're constantly trying to do is look at where the risk-return equation is most favorable. And in the $40 billion that we're managing right now, we have large allocations, for instance, to commodities, to long-short equities, to credit, to macro. And because our time frame is typically over a 1, 2, 3 year period, we have to have a very clear view of what the scenarios are in the future that are going to produce good returns for the different categories. So with Europe now uncertain, you've had a rally in the euro from 120 to above 145, and given uncertainty around Portugal, Greece, Ireland, even questions about Spain, there's a question about whether there will be an opportunity to benefit from a macro standpoint from some of the dislocations in Europe.
Interesting. So macro funds are experiencing some inflows because of the perceived opportunities.
Because of the fat tail events that are potentially out there, where everyone lived through 2008, where you had the housing market in the US essentially drive a concern about overall credit risk and also the financial system, systemic risk. And today, given the fragility of a number of banks in Europe, which happen to own this sovereign debt, even though the ECB has done a very good job of propping up the banks, there is a question about whether there will be some dislocations.
So, I mean, you speak about the growth of the hedge fund industry and its potential to grow even larger. How are hedge funds, how is the industry fundamentally different from, let's say, private equity, which we're seeing sort of it hitting a wall a little bit in terms of fundraising? Funds, 20 billion, Blackstone's raised a rather large fund, but there aren't very many players that can go out and raise a $20 or $30 billion fund anymore. I'm just curious to get your thoughts on, do you think that same ceiling applies to hedge funds? Like, how much bigger can the industry really get?
Well, one statistic that I like to look at is the total tradable securities, equity securities, debt securities, backing out bank deposits. Essentially, it's $144 trillion. And if you look at that as essentially where hedge funds have an opportunity to generate alpha, 2 trillion out of 144 trillion is quite a manageable number. And if you look at hedge funds as simply a different way to manage long only, so a long-short equity hedge fund takes equities and then says, I want to be 150% gross, I want to have 20% net exposure, I want to use the flexibility that I have as a hedge fund to manage in the most efficient way this long-short equity book. Right now, in the global equity markets, there's $55 trillion of equities. So, and if you look at roughly half of the $2 trillion in hedge funds is in long-short equity strategies, that means there's only $1 trillion of hedge funds versus 55 trillion of total equities globally. So the opportunity set is there. And also, you have to look at, if you are a talented investor, you want to be in a structure that is the most flexible, that gives, rather than having to hug a benchmark to essentially every year have to beat the S&P 500, if you're a long-only actively managed. If you then have the flexibility to say, well, I want to be in cash, or I want to have out-of-the-money puts in the event the equity market rolls off, or I only want to have 20% net exposure as opposed to 100%, which is much more of a beta play. Hedge funds give you that flexibility, and I think historically you've had a migration of talent into hedge funds, and I think that will continue.
Interesting. So just shifting gears a little bit from performance onto some larger issues, you and your team have to find the best performing managers. But hedge funds nowadays are drawing attention for different reasons, and there's these insider trading investigations have kind of raised questions as to how hedge funds operate. I'm just wondering, has that affected the way you choose managers, or what's the effect on the industry at large, and then how is it affecting your business?
Well, the two biggest risks investing in hedge funds, first, the risk of fraud, and second, the risk of incompetence. With respect to fraud, if you ask the right questions and you do independent verification, you can actually discover whether there is a fraud. It is a knowable issue. All you had to do was ask Madoff one question, which is, show me your DTC reconciliation, and I want to see, by independent verification, the actual cash in the accounts. And he would have said, I can't show you that. And you would have actually then said, well, I have no interest in investing with you then.
Right.
The competence is a harder issue, because you have to look at not just the track record of these teams, but you have to look at how they have managed the money, depending upon the strategy, in their previous incarnations. If they've come from a prop desk of a bank or an investment bank, if they've come from another hedge fund, you have to look at how they have managed the portfolio, what risks they've taken. With respect to equities and this whole issue around the network consultants, there are policies and procedures that if a hedge fund doesn't have those in place, we won't invest with them. Just like we never even got to having a conversation with Madoff, because the strategy made no sense, much less having him answer the question that he wouldn't have. But as of right now, all of these long-short equity hedge funds that have relied on expert networks, they have to have policies that say, what information am I getting? Do I actually track the information that I'm getting from these experts? Is it legitimate information? And if in fact it's borderline, the policies and procedures are supposed to stop that. And so what we do before we invest in any long-short equity manager is understand what their relationships, if any, are with the expert networks, how they manage the process of getting the information. Do they have internal guidelines where they instruct their team members on what is legitimate information versus information that's improper? And then do they have the ability to track that information, so if there is any deviation, they can deal with the individual?
But these were in place before the insider. I mean,
a lot of firms didn't have these, and so we would never invest with them. In other words, a lot of...
But your checks and your sort of requirements of managers were in place.
We've been doing this since 2000.
Right. So, but has anything changed now as a result of the investigations, or the way that?
No, it's business as usual. Okay. We ask them the questions, and we have our checklist and our guidelines, and we monitor, and we actually track whether they are in adherence to their policies and procedures.
Okay. Now, given your response to my earlier question, I kind of can get a sense of the answer to how you're going to respond to this, but I'm going to ask it anyway.
Sure.
With $40 billion in assets, your business is, as I said before, the biggest of its kind. Is there a point at which you close the fund of funds business to new investments because it's too hard to find as much managers to actually oversee that money?
Well, our strategy in growing our business from 1 billion in 2000 to 40 billion has been to find capacity and also the notion of horizontal growth. So you would be surprised that within our commingled strategies, we have only 16 billion out of the 40 billion. And the commingled strategy is if XYZ institution wants to invest, let's say 50 or 100 million in one of our existing strategies, they would go into our commingled. So they would go into an already existing strategy with usually a 10, 15-year track record.
I see. Okay.
The rest of the money is in customized strategies or strategies where we have built to suit to a given appetite on the part of institutions. For instance, we're now managing $3.5 billion in our strategic alliance funds. Our first was $1.1 billion, our second was $2.4 billion.
Those are the seeding funds.
Those are the seeding funds
that essentially start up.
We're finding teams,
right,
and we're saying to them, we're going to give you 100 to 150 million as a limited partner. We're going to help you set up your business. We're going to give you all sorts of advice on how to negotiate ISDA agreements. We're going to be the good housekeeping stamp of approval vis-a-vis the institutional marketplace. And oh, by the way, we're going to be with you for a 3 or 4 year period as you build your business. Now, we want, through a revenue share, a participation in your GP interest, which we're going to let you buy back from us over a period of time. But we have created now over $2.5 billion of capacity just by virtue of our seeding. So we're creating, again, on a horizontal basis,
you're creating new firms,
new strategies.
Okay, great. Well, thank you so much for joining us.
Okay,
I hope
Cristina,
you'll do it again soon.
Thank you.
sometime.
Good to be with you.